The following is a presentation of TFNN. It is now time for the Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi everyone, Basil Chapman, Tiger Technicians Hour. This is the, I should know this, right? It's the 15th of July, halfway through the month, and been a very interesting month so far. We had a spiral from the low of 2034 in the S&P futures just a little over a week ago. Boom, today's high is 2107, wasn't it? Yep, 2107.50 in the futures. And that is a peak F at this particular point, unless we sneak over 2107.50 by 25 cents. And we're going to be looking at a bunch of things today. And let's go through this very closely. Watched these closely watched indices and tools that we use. Why? Because the rebound is somewhat stronger than what would have expected as a relief rally. So there was a contingent of short covering, but there also looked like there was brand new buying coming in. So we have to assess that. So how do we do it? Well, there are various ways. But in the meantime, back at the ranch, let me run the numbers. The futures are up 3.75. I expected yesterday the best would be a fairly narrow close, a kind of a doji candle. And very important how today acted. Well, yesterday's candle was very good. I remember I heard Steve Rhodes talking about a +9. Certainly got a great call. And right now what we're looking at is the S&P up 4.25 at 2106, holding very, very well, even with Yellen testifying right there. And of course, what is she going to say? She's not going to say all that much that you don't know, that isn't written into the charts. We'll go through these things right away. So support, I would say, is between 2097 to 93 if there is a sudden decline. And on the upside, we've got 2122 as the all-time high. No. It was 2122 as the recent high around about 22nd of June. 2126.25 would be the level to watch really closely on the E-minis. And the reason why I even bring that up is because, look, the weekly chart did pull back just like we thought it would. And for my subscribers, we did go short. We made money on the short side, made a lot of money on some of the positions on the short side. And the mistake was not recognizing the speed. I thought about it, but I didn't prepare us to be able to flip immediately to the other side based on whether the volatility index, the VIX index, we can go to that next. I'll run all the numbers. Here we go. The volatility index, which at this particular point is at 12.87 at the low after going to 20.05. This is a major collapse. It's actually an island reversal collapse in the VIX index. What is it going to take to get the volatility index even back to 15.70, 16.30, that area inside the gap? It's really going to be a huge disappointment on the Greek side to say we are going to accept, reluctantly accept, and then all of a sudden I got a really fine email from one of my subscribers discussing the whole IMF aspect, that there is a chance that they're going to say, hey, wait a minute, from the time we've been speaking, the debt has just skyrocketed. I mean, we're talking about something completely different to what we started off with, and we are either A, not going to accept it right now, or B, we're just going to have to do a lot of negotiating. Wow, that would set in motion the turmoil that we had just seen last week. Put it back on the front burner rather than the back burner. Back burner, as far as news is concerned, as far as the VIX index is concerned, I'll just repeat it like my mantra that I've been talking about for, I'm tired of it, so you must be very tired of it, since November, December. You've got to have the market respond to news as if it's bad news. That is, especially if it's bad news, but any news, if it responds negatively and the volatility index starts to make higher highs and higher lows, and it starts to get into the high teens, you've got yourself a sell-off in the market. Just keep it as simple as possible. As long as the VIX index remains this low, as long as you've got some sectors like IBB, which just constantly comes back again. I mean, even now, it's rewarded anyone who bought the IBB stocks with a short-term trade fantastically. In just days, it's up huge. So until that index really starts to crater, and I mean crater, going to the 350s, we're talking about the lifesaver, the throwing out your lifesaver into the ocean and people just grabbing onto it. That's the IBB. I don't think it's got, I think what's happened now is setting up for me to say, now we're going into bubble territory in the IBB. I never thought we were in bubble territory before. I thought it was extended. It was getting very extended. Had a little bit of a pullback. Hey, 5-7%. What the heck's that? That's nothing. Well, for the IBB, it's something. And now it's that the biotech sector is now back on fire, and fire might be the operative word. So I'm watching it closely. Doesn't mean to say you can't trade it, but just be careful out there. Now, here's the other thing. The XLF, I spoke about it. Unfortunately, we missed starting another position in it. We've been in and out for ages, many times. So it's just trading between the 24s and 25s. There is a chance now that this is the time that I was thinking it would be from the late third quarter into the fourth quarter that the XLF would actually start to move sharply. We'll watch it really closely. Got a couple of questions in the den. Good questions. We'll get to that. Here we go. The Dow is up 26. Let me do it with the charts. INDU. Here we go. See the little one here, down here? This is the one. This is now in leg E in the 120-minute chart, above the 9-period moving average, and above, very much above the 17,927 200-period moving average in the 120-minute chart. So this is a leg E, and it says we are really close to a little bit of a pullback, at least a little bit of a pullback, to test the 9-period moving average of 17,991, but it would not be surprising to hit 17,920s on some kind of a pullback over the next 2 days if there's going to be weakness. And almost all my charts, you'll see them with a 120-minute chart in D, E, or F. So let's continue. So the parameters to watch is the breakout trend line, support at that 18,000 level, of course, and then the 17,900s kicks in. On the upside, any break into the 18,150s says don't rule out the possibility that we're going to test the left side high bar of the 23rd at 18,188, and then we could even try for the 18,200s, maybe make a new all-time high. We'll see about that. But in the meantime, this is good action, especially with the VIX pulling back. By the end of the day, we could be saying something else. Certainly tomorrow, with the Greek vote at midnight tonight, their time, it'll be our time in the late afternoon, early evening. We'll see what happens. Okay. So those are the parameters on the Dow. S&P, SPX has been up today as well. It's up 3.80. The cash at 2112. Left side high bar is 2130. I would say 2116 to 2118 is the resistance on the shorter term. But most importantly, it needs to hold 21. This is the daily, 2102 to 2197 area. You've got yourself exactly the same thing in the 120-minute chart of the S&P, and we're looking at 2102 and 2097. So they are your numbers on the downside. Those are the ones that you need to be watching. Let's go to the QQQ series because the comp is up 18 at 5123. We've got the QQQ series up 47 at 110.74. Now, this is really good action. This is a single leg A. It's almost like going to be an engulfing candle if the QQQ series goes to 111.17 or higher. Why will it be an engulfing candle on the daily chart? Because in a single move, it's gone from a new low at 105.83 on the downside over the past month and a half to, if it does that, to a new high. And you cannot rule out that if it does that, that would set up the chance that you should have not very much higher, but higher peak B, peak C, and maybe a peak D running into, it'll take at least a week if this is only an A. It'll take a week and a half maybe to get to that D. So I'm watching this really closely because the area yesterday that was ripe for failure was right at 109.82, and it spiraled through that. So once again, we're in leg E in the 120-minute chart, suggesting we're really close to at least a little bit of an intraday pullback. Have to admit that the weekly chart technicals and the daily chart technicals are really poor. It's only the 120-minute chart at 97% in the stochastic that's suggesting that it can go higher, because this is going by price. Price is dragging the technicals higher, but it's not making the technicals bullish. So we're going to be watching that closely. Now let's go to the IWM quickly, and then I'll run the others before we go to the break. Leg A up in the IWM, the Russell 2000. This is way underneath the 129.10 high. It's at 126.24. Had a nice bounce from the 121.50, was it? 121.28 low that was made on the 8th of July. So the monthly chart in all of these charts, they are still very strong in the price, but the technicals have been fading, and this is a PD in 120 minutes of the IWM, Russell 2000. Let's go on. We're going to look at gold. Gold at this particular point is down 8 or 9 at 1144. Lower. Look, I've spoken about, I don't know how many times I've said that 9-period exponential moving average. I love watching that thing act as support, walk the 9 EMA, or be repelled by the 9 EMA, and that's exactly what's happening here. But it's really the chart patterns that I've been drawing for so long. Look at the GLD. Drew this over a year and a half ago. No, it might be even 2 years. I drew this back in July of 2013. I drew the H pattern, maybe it was in August. But once it was running, I said, you could set yourself up for an H pattern that could go towards the 200-period moving average, but it'll continue as a lowercase h that goes to a lowercase m. Now, I'm going to be talking about these patterns on Monday night for my subscribers. It's only subscribers. It's a free webinar. It's going to be Monday the 20th, 5:30 to 6:30. I'm really looking forward to it. There are a couple of reasons why I'm looking forward to it. One is I'd spoken about, well, actually, no, let me do this. The GLD making a lower low, and it's testing it, the low today of 109.58, because I will be introducing the gold and the dollar and what's going on in the larger context on Monday night. What we're looking at, because I've spoken about Dow 17,500 for a long period. My thinking was we would break under it. That was the one alternative. That was my thinking. But the actual position that I said we would be trading was that if you go to a sideways consolidation and just keep rotating, that's what we've got to be looking for. So gold is down 91, GLD is down 91 cents at 109.83. We'll talk about the break to the lower side when we get back. We're looking at high-grade copper down at 2.52. Not good. Crude oil down 76 cents. Bonds up 5 ticks, and the dollar up 47 cents. I'll be right back. Basil Chapman, Tiger Technicians Hour. Don't forget my webinar. Check the front page out right now. We'll see what it's all about.
If you're looking for a great opportunity to diversify your financial portfolio, consider the Principal Protected Market Safe CD from Everbank. They've just released the second running of their 5-year Market Safe Power Metal CD, which combines the power of gold, silver, and copper. You get exposure to 3 valuable metals in one index CD and have the potential to earn up to 45% capped upside payment at maturity if the metals increase in value across annual pricing dates. And should they decrease? No worries. There's zero risk to your deposited principal here, as you still get 100% of it back. Keep in mind, returns are based on CD performance. There is no annual percentage yield or periodic rate of interest on the CD. Intrigued yet? The August 17th funding deadline is quickly approaching, so hurry over to everbank.com/TFNN-CD for more information, including important product details and disclosures. Once again, that's everbank.com/TFNN-CD. Everbank is a member FDIC.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Basil takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, folks, we're back. So the Dow is up 26, S&P is up 4.5. This is going to be an important phase, and I'll explain why. There's a technique that I call the single leg A up. That's number one. So let's just set that aside for a moment. In stocks like Celgene, which is taking over one company, but it's up 11.95 on that news at 134.80. Breaking out in the weekly chart in a Chapman Wave Cup and Ladle breakout, which says I really do have to call this peaks a leg C. So it takes another week to make a peak, and then maybe there's a D. I could call it an alternate wave. I think to be safe, I need to call it an alternate wave count, and I'll explain why. Because the pullback was very brief, and it came from a starting point in the weekly chart in the last move down in the 80s. 83, was it 83? 83.16 back the week of the 17th of October. And it's gone to A, B, C, D, E, pulls back sharply. But that sharp pullback saw the MACD and stochastic pullback really sharply. Technically, everything else says that it should be C, except for one thing. There are periods where you take that U-shaped pattern, that cup-shaped pattern, and within that cup shape, which is also a U, but within that cup-shaped pattern, the breakout says that the technicals are starting to move well, but not good enough. Look, the MACD is just broken to the upside, but it's still very low, and the stochastic hasn't gone to 80% yet. So this could turn around and go for 2 bars to the upside and then start to curve down and come back way under the 70% level. So therefore, I've got to say, look, peak C, a leg C in the daily, Nothing wrong with that. It should still make a D. Not only that, if you go to the 120-minute chart, look how well. So this is a breakout. So let's call that DABC. Yeah, let's just say that the pullback that's occurring from the high today of 135.98 is at 134.50 with a low of 131.72. Pulls back but doesn't take out the 131.72. Then on a 30-minute basis, you could have, let's go to the 30-minute chart. You could have put Celgene's SCLG right there. So Celgene could have another upward biased. So that we got here. This is an A, B, C, D. Oh, there you are. So we could have a pullback and then have another inside, probably a 10-minute peak A, B, C, D. If it breaks down and at any point in the next, it has to be ready soon. So it has to be, what's today, Wednesday. It has to be by Thursday afternoon, Friday morning. It has to be taking out the low of 131.72. If it does that and then closes the whole session, this is not just the 30-minute chart. No, I actually would like to look at the 120-minute chart. If it closes the whole session, this one here, underneath, way underneath, at 130.50 or lower, Celgene says, hey, the top that was just made, it's going to be real tough to retest the top. It has to do a little consolidating before it can do that. But let's just put into the context of the IBB, which is the NASDAQ iShares Biotech ETF. Well, looking at it, this is a spike up, a gap up to a leg F. The MACD's are very strong, and the stochastics at 97%. So that suggests that we could have a bit of a pullback here. And maybe in the IBB, the 390.96 low will be filled in at some point. But my suspicion is it goes sideways for just a little bit, and then comes the big test, because the move today, the move over, look, to go from 360 up 40 points, up 12, 13%, when in fact you just pull back 7%. That's a huge move. Now, we got that very night. Look, we were short right there, the second bar after the second day after the top. The top was on the 19th, and on the 20th we went over the long weekend. So then we went short on the 24th. And look what happened. It came down very sharply, and you went down to the 360.57. We covered, made a small amount of money because of the speed. Doesn't matter, we still made money. And instead of flipping to the BIB, which is kind of what we often do, I didn't do that. And that was a mistake. The reason why I didn't do it is the way that the charts were coming down. If I looked at Amgen, part of the group, look, Amgen was right down there. Now, let me just move this away. Look, Amgen was making the H pattern, pull, but even now it's rallied very nicely, but nothing like it should. It hasn't gone to the 173.60 all-time high right there, the week of the 24th of April. But it is running, I mean, that's, the reality is it is. BIIB, Biogen IDEC, nothing, look. You remember we had a call from Marjorie, was it? Jennifer from Wellesley. And I said, be careful if it closes underneath the low that was being made at that particular point. I don't remember what it was. I said, just take a little bit off. You were the one to get in. It's good that you got a long-term gain. I don't want to spoil that, but I do want to say, if you're asking my opinion, I think we're starting to get somewhat toppy. And this was one of the leaders, Biogen IDEC, and it's starting to fail. So I wanted to just say, there are sectors that are going to bubble territory, and I think this is one of them. I'll be right back. Basil Chapman, Tiger Technicians Hour. Dallas up 18.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now, you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com. Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
You know what's cool? Taking something that's good for you. Something specifically formulated to help with weight loss, better sleep, stress reduction, and the need to detox.
Nico, our hunter and gatherer ancestors found all their nutritional requirements for health in their wild environment. But today, our food sources no longer contain the vitamins, minerals, and nutrients our bodies need to stay healthy and strong.
That's why we need Primal Edge Daily Nutrition. It includes a special blend of ionic, soil-based vitamins, minerals, fatty, and amino acids in an easy-to-use liquid form.
Primal Edge is powered by highly concentrated fulvic and humic acids, nature's preferred delivery system. They have been called miracle molecules because, like sunlight, air, and water, life cannot exist without them.
That's right, Paige. They ensure we receive all the nutrition we need to be healthy and thrive. We take it every morning.
Primal Edge, formulated and approved by Nico and Paige of Living a Primal Lifestyle. Buy it today for just $89. Click on the Primal Edge banner on the front page of TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, folks. We're back. Basil Chapman, Tiger Technicians. I said we get back to bonds. I send my subscribers this most weeks. This is the weekly triple yield chart, and what it shows you is the white bars right here. That is the 30-year T-bond yield, TYX. The 10-year T-note yield is the TNX. And the 5-year T-note is the FVX. Spent a lot of time talking about peak Ds and Es in the Chapman wave, 4th highest and 5th highest peaks. And that very often in bonds, you get the E that turns down very sharply. There's just one example of an EFG, very quickly done over a period of 5 weeks. This is a weekly chart, maybe 6 weeks. And that then went to the 39.74 major high before plunging down to the 22.26 low. That's a huge decline in percentage terms. Then we went recently to 32.55. That's E. Look at this bar right here. See, it's down and we're at the low of the bar. You see this horizontal line? What I've been pointing out is we've kind of been in this area many times over the years, so you can't use this as some kind of example of, oh, higher rates, higher rates. This is just rates. It's just in the middle of the range. Higher rates is when you get to 4. This is a 3.255. And then it's still very low because historically it would be much, much higher. When we talk about much higher, look at this. This is the September 1981 high. And this is all smoothed out because it's a continuous contract. But I've got it here at 15.2. I believe it was higher. I know that mortgage rates in that particular period went to, in some instances, 17%. Can you imagine 17%? That means the house that you could have bought if you were using the payment, the monthly payment. Can you imagine how bigger the house would be if you were using it when rates were down in the 3-4% area? It's just, there's a huge difference. But what's really fascinating is from 1985, 1986, this down channel began. And we're only in the middle of the down channel, except, let me show you something. The reason why I think we've got to take this particular phase a little bit more seriously is that when you look, half close your eyes and look at this chart. If you look at my chart, this is a monthly chart of the TYX, the 30-year Treasury bond interest rate. And you will see that from that low, where the 9-period exponential moving average, which about a year ago I decided to make nice and thick so that you can see it, because it is such an important tool in my work, in my body, my huge arsenal of technical tools. Look how much higher it is there. Let me just show you a parallel line. Look, there it is. Oh, that is fascinating. I love it. You know, I always consider myself to be quite good at looking at plumb lines and things like that. I've always been able to measure by eye. Well, it was so deceptive having gone down to the 22.26 level. I wonder if that's smoothed out and changed. No, it's still 22.26. That I thought that this one was slightly higher than that. But no, the 9-period moving average, let me see, 9 EMA, where would I find it here? Give me a chance to get it. Down average experience and a 9. I'm looking for something that says 28. Okay, is that? I'm not sure if I average exponential. There it is. So 28.91. And here you've got 24.45. 24.45 to 26.96. Okay, it is. It's a tad lower. Isn't that nice to see? I mean, not so nice because I thought it was slightly higher, but it's nice to know that it also went down with the price going lower. But what I wanted to point out is that it's almost the same. Although the price went down quite a bit more, the 9 EMA is almost the same. And that's saying to me that we're starting to flatten out. Instead of much lower lows, we're starting to make just modest lows, quite a bit lower highs. Now comes the big test. And why do I say that? Because the week is just halfway through, and 32.55 was last week's, 32.55 was last week's high, in the last month's high in the yield. And this month we've gone to 32.45. So another 11 cents extends leg B. So it's really worth looking at this very closely. Now, the technique that I always talk about, and what I want you to bring up because of its relationship to the GLD chart, is a pattern that I call the lowercase h. What does it look like? You saw it before. It looks like this. And you get the left side arch, and then you get the right side arch. And if that right side arch takes out the left side low bar, fails to rally above the previous peak or a 9-period moving average or some important technical tool on the rebound, it'll go lower. And you've seen that happen. Look, almost successful, not quite, goes lower. Another one, another one, and another one, and another one, and another one. So this is very important. Why? Because we're up above the 9 EMA, and the next left side peak is right there, 35.16. So if in the month of July, if the 30-year T-bond yield goes to 35.17 and actually closes above that, that'll suggest you've got the next resistance level to go to. And that would be the downtrend line, and that downtrend line has been immutable. It just has not been able to close above this line at all. Since the channel already began, look at this, way back. So I've got an inside track as well, but the channel started right there. So this is going to be very interesting. What happens to yields? And I've been talking about the Japanization of our bond yields for who knows how long, 10, 12 years, 13, I don't know how many years it's been. The Japanization of bond yields meant that I was looking out over a period of time where the economy would get to such a strained relationship, maybe even with the stock market, that the Fed would feel impelled to constantly lower rates, just like they did in Japan. The big confusing thing for me has been Japan never had a rally in their stock market. We didn't have a rally in our stock market. We had a monster, mega bull move, which is still going on to this day. And we were only 300 points off the all-time high at 18,000 in the Dow. So in this context, when you're looking at the relationship of the United States to Japan, there is one major inconsistency, not the economy per se, but the stock market. Well, of course, Japan never said, hey, we've got oodles of boodle. We're just going to be printing money. We'll just print our money. You tell us how much to print, and we'll just print. And you know what? Whatever you tell us to print, we'll double it, we'll triple it. And that's what the Fed has been doing, just pushing money out. And that cheap money has been the fuel for a lot of the recovery in the economy per se, not in the jobs relationship and many other aspects that we could measure. So, and I also think that they're measuring the jobs incorrectly. I think there's an underground economy. There's an economy that's working in a different way. And maybe I don't mean it illegally, although there is an illegal underground. I think there's an underground economy that doesn't measure the same way as it used to. So it is a different kind of economy. I've met many people who have 3 jobs, 4 jobs. They work from home, or they go to a particular place, but only for a couple of hours. And then they freelance, they do all sorts of things. So that's very important in a country where you've got over 300 million people. All right, so let's get back to our story. The yield, if the yield at any point in July to early August starts to go under 2.76, it's at 2.926. That Japanization of our bond yields is continuing, and it's implying that the RTH maybe is a clue, right here, the RTH, the retail index, that's the one which has gone sideways with the market. And these sideways, remember, a rectangle formation can last a lot longer than your patience, number one. And number two, very often it's at 77.93. It's a mere 80 or 90 cents below the 78.75 all-time high. And it's just gone sideways. The whole consolidation is taken from March to today because we haven't broken to the upside. And the most important candle is this candle of February, week of the 13th at 74.04. And all we've gone to is 74.25. We've held that. And even the pullback last week went to 74.47. So maybe the retail index is alive and well. And if it breaks out, rather than going to the top of the rectangle formation or maybe fractionally higher before pulling back again, that's going to say something. And let me explain what I'm talking about. Let me move this monthly chart. Look at that. That monthly chart is at a sideways consolidation. If you see the RTH, the Market Vectors Retail ETF, break out and go to, I'd put it, it shouldn't be difficult to go up another 2.5 points. Let's just say, let's call it 80.90 to 81.30, that area right there, right there. If it does that, I have to consider that in the weekly chart, that is a breakout. And I have to recount it, and I have to say, that's new leg, if it does it this week, breaks out above 78.75, that is new, it's old leg E, but maybe new leg B. And then we've got to watch to see the MACD and stochastic. Now there's another one, there's the RTX. I know this is the RTH and the X. Somebody help me. I know these so well, and all of a sudden I'm blanking out. What is the X S&P retail index? X retail. I'll get it in a minute. And in this particular instance, retail ETF, and we should have the Excel something. Here we go. We've got S&P Spider Retail is right there, and it's called the, it's hiding away from me, XRT. I did put an X in, but I forgot the RT. XRT, I said RTX. XRT Yeah, same thing. Look at this. It isn't quite as strong as the as they made up fairly similarly. XRT. Thank you, PK. I got that. And so if I'm looking at this XRT, so we've got peak A, peak B, peak C, peak D. Okay, that's fine. Let's just do this. B, right there. A real struggle, but it is going higher. It doesn't matter how it goes higher. And that's a D. And you've got yourself a triangle right there. Look, declining lower lows and higher highs. Okay, make it real simple. If the XRT, the SPDR S&P retail at 100.83 goes above 102.50, let's just say not just 102.50, really, it needs to break out. It needs to go to the 104s. And if it can go to the 104.50 area, I have to consider that is a breakout of significance. And in this case, it'll be peak A, B, it'll be leg E/C if it does it this week by breaking out at least. So I'm looking at this and I'm saying, this is very interesting. The stochastic and the MACD are terrible. The price is held. If you had said to me, wait a minute, what is the history of this particular pattern? And the history is that when you get a rectangle move, this is not an oval, this is more a rectangle move, and it continues for a certain period of time, if the technicals start to fail, the price at some point should follow the technicals. It isn't usually the other way around. Hey, oh yeah? This is saying, oh yeah? Watch me. So I'm going to be watching it. So that's the XRT and the RTH. To me, those are very important components of the market makeup, not just the components of the stock market, ETFs, but of the whole market. It's telling us about retail, telling us about, look, RTH is telling us about Walmart, Home Depot, Amazon, CVS, Lowe's. See, Amazon is a big part of this. It was looking lousy the other day, and then, woof, it goes to the upside, F/A. Can you believe that this could be an A? And leg D in the weekly chart. So we're going to be watching this very closely because Amazon finally, regardless of whether they're earning, about the earnings, and of course, brilliant, Bezos just plowed the money back into making it the best of the best. I know that if I need, I'm not a good shopper. I look at shops because I'm always studying to see what there is, but I'm not a big shopper. I have to get nagged to buy something. And at the same time, when I do ever get anything and I need it real quickly, I just go to Amazon. Oops, it's so easy. They've made it simple. So that's the story there. Now, let's continue. So we've got Amazon acting well. Google sort of picked up its head the other day. Very nice. Oh, nice action. But it hasn't made new highs. It's in this consolidation phase still. So we've got to look at this and say, what are the characteristics that are going to give us the kind of move? Now, let me move to a monthly chart. And this is what I'm going to be talking about on Monday. What are the characteristics? I'll talk about the socioeconomic, political, and the trends that we're looking at that are so familiar. To me, having read page by page of the 1920s into the 1930s of the New York Times, a lot of what I'm looking at now is just so, it's like I'm living in real time what I'd read about. Whether it is alcohol, its relationship to marijuana, to the lifting of basically the sanctions, right? There are so many parallels. Tattoos, body art, there are so many things that are paralleling the 1920s. We'll talk about that on Monday night. Hey, I'll be back. The Dow's up 12, S&P's down up 242. We'll be right back, and we'll look at some of the indices like the IYC.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Up next, the Diagnostics Trading Hour with Daryl Martin here on TFNN.
Hi, folks, we're back. So the IYC consists of the iShares, Dow Jones, U.S. Consumer, Cyclicals. It has Walt Disney, Comcast, Home Depot, Amazon, Walmart, CVS, McDonald's, Lowe's, Walgreens, Starbucks, Costco, just, you know, the works. Priceline, McKesson, Target, TJX. So it's in leg C, probably peak C today in the daily. The weekly is broken out. Now, there could be a Chapman wave stork leg formation, and I've got this as an F/B. Technically, I put the down arrow because the MACD and stochastic really failed, but actually the price held well. Normally, I'd have to put a plus sign there, but when it closed down that low and then came back again, that would have said, you know what, you have every right to put a down arrow in the Chapman wave. So this here is an aberration, this leg F, if, in fact, we go from 148 down to the 145 or lower area in the next, I'd say in the next week. All right, just make it simple. But look at Disney. I've followed this almost every day. I've been saying, okay, I had to reboot, and I lost that. So let me just put this back in. I put it in the wrong color. A, B, instant restart, C, D, E. So this is going to be very interesting. Why? Because it's in leg E. It's kind of stretched in the daily, although the technicals are still good, but the unbalanced volume is suggesting, whoa, be careful. It's getting a little bit overbought. This is just the daily chart overbought. The 120-minute chart made a high today, which is in leg F, which says, so many charts have made their peak E's and F's this morning into right now as we're talking, that there should be some kind of a pullback in the next day or two, a little nervous pullback. I'm not sure if it's going to get deeper or not. I would say that if there's real disappointment, this market is not ready now after the big rally for big disappointment. That would be a real shocker. So the bias right now is to be looking to the upside. And you can see Disney's still acting well. It's in leg G/C in the weekly chart, leg E in the monthly. So far, we've seen stocks that act like this consolidate a little bit and then push away from the 9 EMA. So at 118.34, if Disney, matching the IYC, if Disney, for whatever reason, I don't care what the reason is, it might be the stock market dragging down, it might be news on Disney itself. They've done fantastic things. This is the period where you've got to be watching for some kind of mistake or something happening. So if Disney starts to trade under 115 in the next 2 weeks, that's going to suggest that the weekly chart could be making some kind of a shorter intermediate term top, but certainly the daily chart says be careful because the support level at that 115s area is good, but if it starts to take it out, there really isn't much until you get to the 113s. 113.83 is the 9-period moving average in the weekly chart. Nothing yet with Disney, but I'm on watch because it's real close to giving at least some kind of a pullback. So now what is today? Today is Wednesday. We've got Daryl coming on next. Got a program all the way through. Fabulous program, folks. So let me just do this. I'm going to give you my parameters. And I'm just going to say if the volatility index, which is at 1304, remains in the low teens, that's buying pressure. Just keep it real simple. And if all of a sudden the VIX index, instead of being in the low teens, bounces to the 16s or higher, accompanied by bad news, you've got yourself the situation that says, all right, be careful, because the recent gains is a single leg A up, and that's that single leg A up syndrome that I'm always watching for. It's really bullish if the Dow pulls back and holds the 17,800s and then starts another move with a new recovery high. That would be very positive. But if there's a pullback from this potential doji candle right here, and that pullback goes under 17,800, that's 250 points from here. No, 100, yeah. 250 points from here, that's a lot of points. But if it does that, just be real careful. Meantime, I'll be back tomorrow. Check out my opening call. Check out my webinar that's coming up Monday night, 5:30 to 6:30, about the match with the 1920s, which continues to this day. Stay tuned for the next shows.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
This is TFNN.